Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. In this video, we are going to continue discussing reporting of the property, plant, and equipment, which is also called PP&E, and other fixed assets. The purpose of this video is to discuss the depreciation and the depreciation method called straight-line depreciation. Depreciation comes from using of the assets. So after we acquire the assets, we would be using the assets. Using the asset involves a process called depreciation. Depreciation is the process of allocating the cost of the building or the equipment over their useful lives and in a systematic and rational way. So let's start with acquisition of the assets. When we acquire an asset which is unused, we put all the acquisition costs, as we described in the previous video, in on the balance sheet. We call that process capitalization, right? We capitalize all the acquisition costs and form a huge amount, put them on our balance sheet. That cost, when the asset is used, would gradually be transferred to the income statement in the form of expenses. Now, this transformation process, you will see in the next couple minutes. I'll use an example to illustrate that. This transformation process or cost allocation process called depreciation. When we calculate depreciation, we follow some assumptions which we'll talk about. But depreciation related to the current year would be in the income statement as expenses, but all the depreciation from day one of the asset until today, which is called total depreciation or accumulated depreciation, would be presented on the balance sheet. Now this looks very complicated, but we will illustrate that in an example. In business, there are different types of methods companies use to calculate or to allocate the cost of the asset across different years. Now, in this course, we only focus on straight-line depreciation methods and the intuition behind those numbers. So there are other methods such as unit of production, declining balance, such and such, but we are only going to focus on straight line. To calculate the depreciation expense, 3 pieces of information will be required. The first piece is the acquisition cost, which we talked about in the first video. These costs are the invoice costs, freight-in costs, and all the costs that preparing the assets for use. That's what we call capitalized cost. The second piece of information is the estimated useful life. Now, pay attention, the useful life of a machine or building are estimated. For example, you could estimate the building will be used up in 50 years, whereas the building may well be standing there and well functioning after 50 years. So the useful life when calculating depreciation is only an estimate. And the GAAP provides guidance on how many years, basically there's a range that how many years a building should be depreciated. Finally, we need to know the residual value at the end of the useful life. For example, if you have a car, now we know how much we purchased the car for, right? We know basically estimated, normally a car would be used up in 5 years. Then you have to estimate what is the basically end of life cost. For example, when the car is totaled or used. You can send the car to a garage or salvage yard, and the scrap yard will give you some salvage value, right? Will give you some receipt. Will give you some money back, basically for the piece of metal you sell to them. So that is called the salvage value or the residual value at the end of the useful life. These 3 pieces of information will be used when we calculate the asset's depreciation. Here is an example. Southwest Airline Company acquired a new service vehicle on January the 1st, 2019. The cost of purchase is $62,500, and estimated residual value at the end of the life of this vehicle would be $2,500, and the useful life 3 years. Okay, so now let's use something called the straight line method to calculate depreciation. The straight line method is an assumption. The assumption is that we are going to use this vehicle in 3 years, and we are going to use it evenly throughout the years. Okay, so every year, basically, we take the same depreciation, or we assume we use the car very evenly throughout the year. Now, whether that assumption is reasonable, it's another subject, but it is allowed and it is commonly used as an assumption for depreciation. So how do we calculate depreciation? We will be using the original cost of the vehicle $62,500, subtracting the salvage value $2,500, that equals to $60,000. Now this $60,000, the basically difference between the cost and the residual value, the cost we paid and the cost we can recover at the end of the life, the difference between the two is the total cost that available for use, right? Available that can be used. Divided by 3 years, because we assume every year we use it evenly, so we divide it by 3, we got $20,000 per year. That $20,000 would be the depreciation expense for every single year during the 3 years. So you can always compile something called depreciation schedule to show the depreciation of an asset. For example, in our example a moment ago, the depreciation every year starting from year 1, so year 0 is the year we purchase the vehicle. So starting from year 1, every year we are going to use up $20,000. Alright, so on this schedule, I put down the historical cost, which is the capitalized original cost of this vehicle, that's $62,500. Now, pay attention, the historical cost will never change because this is how much we purchased the vehicle for. Starting from year 1, every year we are going to use up $20,000. That is the depreciation expense. Every year is the same. We are using the same amount, right? This depreciation expense is in the income statement, okay? In the income statement, we recognize the depreciation expense for $20,000 every year. So, because now remember, depreciation expense means how much value of the machine has been used up in this year, okay? So that's what depreciation really means. It means how much has been used up this year. And the first year, because we used up $20,000, this is the first year, so there is no accumulated depreciation in year 0 because we just purchased the machine. So the first year accumulated depreciation, which means the depreciation added up from day 1 to this point, is just $20,000. Accumulated depreciation reflects how much machine has been used up, right, from day 1 to today. Okay, so it's accumulated amount. So it's from day 1 to today. So for year 1 is $20,000. The net value shows you how much money or resources has left in that machine, in the PP&E, right? So for the first year, if this is 1, this is 2, and this is 3, net value 3 equals to the original cost 1 subtracting accumulated depreciation 2. So it's the original cost subtracting how much has been used up since day 1 to today. So in year 1, net value would be $42,500. It is the original value subtracting how much has been used up. That's 42,500. Year 2. Year 1, we used up 20,000. Year 2, we used up another 20,000, right? That means in year 2, accumulated depreciation would be the 2 years depreciation expenses added up. That's 40,000. 62,500 subtracting 40 equals to $22,500. This is how much dollar amount has left in our machine or our vehicle to be used in the next year. The last year, the third year, we use up another 20,000. So in year 3, accumulated depreciation will be 60,000. Okay, it is just the 20 plus the 20 plus the 20. So that's the 60. And how much is left in your vehicle? That's 62,500 subtracting the 60,000. That's 2,500. Right? Wait a minute. Why isn't my vehicle go to 0? Why is there a 2,500 left in the vehicle? Now pause the video, think about this question. Have you seen this 2,500 somewhere before? Yes, you did. That is the residual value you have estimated, right? So you can see this scheme, it's actually really a good scheme, a good schedule, because at the end of the day, the net value of the vehicle reflects how much left in the PP&E, 2,500 left in the PP&E, which is your estimated salvage value when you sell this vehicle to the scrapyard. So, in summary, this is a more beautiful schedule, which is the same as what I have just done. But basically, I want you to understand that historical cost, accumulated depreciation, and net value are all reported on the balance sheet, reflecting the original cost of the assets, how much has been used up to today, and what is left. Depreciation expense every year would be the same under the straight line, and it would be reported in the income statement. So if you read this beautiful table, it just tells you the same thing. It's the how much has been used up during the year, the balance of the contra asset account. Okay, accumulated depreciation is a contra asset account, so it works against the PP&E. It's a negative sort of PP&E. And then the net value is how much is left, which is the cost subtracting the accumulated depreciation. Now, I want you, if you want more detailed information, you should watch McGraw-Hill Guided Help video A-2, Depreciation of PP&E. That video has talked about different assumptions. I want you to watch only starting from 7 minutes 35 seconds. Okay, that is where the straight line depreciation method kicks in. Of course, if you are interested, you can watch the unit production and the double declining depreciation, which use 2 different other assumptions. All right, so this concludes chapter 8, and I'll see you in the next chapter.